Good morning, everybody, and welcome to the September edition of the Balanced Perspective. As usual, I'm your host, David Levinson of Neg Group Investments, and we're joined online by a nicely relaxed, he's picked up a new tan, he was on holiday last week in the Kruger National Park, Iain Power of Truffle Asset Management. Iain, as always, thanks for joining us.
Morning, David, and thanks for having me on this morning's chat.
Thank you very much, Iain. Thanks for joining us. And Iain and I caught up just before the discussion now. He said he saw more leopard than impala. So if you're like me and you haven't seen any leopards in the wild, I suggest you piggyback on Iain's next safari trip, because who knows, you might be a lucky charm. So since we last caught up, got the giggles here. Since we last caught up a month ago, the markets have moved a little bit up and down, but roughly kind of ended where they started the month of August. And I'm now falling into the trap of short-termism. And that's very much the topic for today. I thought I'd give Iain a pretty tough topic as he came back from his holiday about markets being irrational in the short term, yet reverting to some sort of sense of normalcy or rationality over the long term. So, Iain, I'm going to bring you in here for your first question. A lot of fund managers in South Africa refer to markets being irrational in the short term, and they benefit as this reversion takes them back to some sort of state of efficiency or rationality. But before delving into any of these, maybe you can describe for us what is meant by market efficiencies and how do these typically present themselves, importantly. Would they be at a geographical level, a asset class level, a sector level, or even a company level, or maybe a combination of those?
Yeah, David, I think that's right. So I think efficiency is something which, if you're an active manager, you believe that over time, as we do at Truffle, that markets over the long term are efficient. In other words, that they will price securities correctly based on the sets of cash flows that those businesses generate over time and the rates at which those cash flows grow. And that, I guess, is one of the principles of our philosophy, is that we believe the market is efficient over the long term. However, as you said, there are many, many periods where investors, for various reasons, can become very optimistic about future prospects. And typically that optimism manifests in ratings of stocks that start to grow. In other words, the PE or the discount rate that investors are applying to those cash flows changes in such a way that the expectation of growth at high rates will continue into perpetuity. And as we know, this often is not the case. Ultimately, when those growth rates slow or disappoint, then those high-flying multiples typically compress, and that's really the mean reversion or the efficiency piece that we talk to, being an active manager. So I think for Truffle, we really pride ourselves in understanding the value of businesses and then comparing prices to value to get a sense of those inefficiencies in the short term. And as you correctly said, those inefficiencies could be because people are too pessimistic about prospects in the short term. And many of the SA Inc. names, as you'll know, we've been holding some of the financials. ABSA is a good example in our portfolios where you were able to buy this stock at sort of a discount to NAV, despite the fact that the business was continuing to grow, compound its cash flows, strong capital position, improve its efficiency ratios. And it was just not reasonable that the stock would continue to derate. In other words, that the PE would continue to fall as the cash flows grow over time. And inevitably, what you need is some efficiency mechanism or price discovery where investors say, hold on, the stock can't trade on a 4 or 5 PE, probably should be on a 7, 8 times. And that's where you start to get the mean reversion. So I think the inefficiencies are what give active managers space or a reason to exist. We think if you can't beat a benchmark, you shouldn't be managing money, because investors have the choice to buy a passive product at very little fee, which will track the index.
Thanks, Iain. I could swear you have a line of sight to my questions here, and you do this every week. You almost preempt what I'm going to ask you there, and you gave a stock example, and I might readdress that later on in the session today. You did speak about pessimism. So a lot of market inefficiency in the short term is driven by things like pessimism, anxiety, fear, optimism. So really the sentiment of the market. So I'd like you maybe to give us an example of some time in your history as a fund manager. Now you can pick any moment in time where that efficiency existed and you were able to, on the back of that inefficiency, protect capital, or the converse, actually, generate nice returns when that reversion happened.
Yeah. So, I mean, I think probably one of the most recent examples, which we've all lived through, is COVID. And I think, when COVID really unfolded and you saw a massive price compression of equity markets and risk assets, lots of these equities were pricing in negative earnings growth into perpetuity for some of these shares. And I suppose, as a fund manager, what is an exciting time is when you get presented with opportunities where you can buy good companies which have been sold down equally with average or poorer quality companies because of some exogenous shock like a COVID. And ultimately, we know that the difference between those business models is vastly different. And you then get the opportunity to buy into decent or more quality businesses at bargain basement prices. So, I mean, COVID would have been an example that would given you an entry point, and it would have compressed all businesses' ratings, whether you were a commodity or whether you were a higher quality business. Everything went down. And I mean, those sort of environments are great as a fund manager because, not only can you buy into assets cheaply, but you can buy into better assets at a cheaper price, which have the ability to compound over a longer period of time. So I think, that would be one of the points that would come to mind. I mean, another point or data point that comes to mind is during Ramaphoria. So we had at Truffle, we had purchased or were holding lots of SA Inc. names, retailers, banks in the portfolio. Cyril Ramaphosa won the presidency, and we saw an explosive reaction both in the rand as well as in the multiples of many of these interest rate sensitive shares. And over that December period, I can remember it clearly because I was on the phone telling the dealers to sell Fashinis at 220 rand. And we exited pretty much most of these positions and really taking advantage of a data point which resulted in a lot of optimism, which perhaps then wasn't justified in the fundamentals as we saw it in the ability of those businesses to grow then over the years that followed. So I think it's as an active fund manager, you're always looking for those entry and exit points. And I mean, the sayings you well know, when there's blood in the streets, you should be looking for opportunities. And typically, you only find opportunities when there is some bad news. Things don't go down and multiples don't compress because there's good news. So I think typically that does give you entry points, which can make a big difference to portfolio returns, particularly if you lean in from an asset allocation point of view, as we did at those particular points.
That's a great example, or a great couple of examples. Thanks very much, Iain. I'm typing away as you chat here usually. I was having a discussion with Amy Jensen, our behavioral science specialist, earlier, and I brought up the concept of myopic loss aversion, where apparently Daniel Kahneman from Thinking Fast and Slow and his colleague came up with this concept that you'll see markets react on the downside, or at least people are twice as sensitive on the downside than they are to the upside. That's why we typically look for opportunity when markets sell off aggressively, but also it's about remaining cautious when markets are on that slow escalator up for potential some of those downside risks and where that dislocation or irrationality might appear in the market. So Iain, currently at a global level, so you mentioned COVID. Are there any current macro themes that might be potentially offering some sort of short-term irrationality, whether it's in the rate cycle, the conflict in Ukraine, some of the news out of China, or anything locally for that matter?
Yeah, so I mean, I still think local assets from an SA perspective, there's a lot of bad news that's priced into these assets, both from fixed income, real bond yields are still pretty attractive. The health of the country's balance sheet is still quite good. Terms of trade are still reasonable. So that to me suggests that, there's lots of value in our fixed income assets, as there is in some of our equity assets. So I think lots of bad news priced in there, and we all live here, so we sort of know the issues that we're dealing with. But the reality is, when you look at the performance of a lot of our companies, they've actually done a pretty good job in what has been navigating quite a tough environment, both from SA's own structural own goals, as well as COVID. And I mean, that's really resulted in SA equities trading at quite deep discounts to their long-term medians, which means that prospective returns going forward, look fairly compelling. And, what is the catalyst going to be for that? One can't say. But I think what we do at Truffle is we'll try and identify value and assets which are mispriced. And it looks like SA assets are mispriced, and you're being paid to take some of these positions. So, we are overweight, some of the SA-centric assets. From a global perspective, I think perhaps the situation, slightly more complex and muddy. But I think the world is still trying to unravel from a period of super low, ultra low interest rates and monetary policy, which has resulted in excessive risk taking and a lot of moral hazard. And I think ultimately a big misallocation of capital. So when the cost of funding, when there's very little cost attached, funds seem to find their way into projects which perhaps didn't deserve it. And I think some of that is still going to wash out of the system as rates and fiscal or QE gets sort of pulled out of the system. And then there's areas where there is quite a lot of bad news starting to be priced into some assets. And European equities, for example, right now, some of the European banks, have been sort of bashed up. And, one's not saying that they're about to turn, because obviously we all understand what Europe is going through, and there are some tail risks. But I think there's very clear examples of where you can see more bad news being priced into some assets, and perhaps less so, for example, in the United States. China, you sort of touched on China. I mean, they're going through, their own, some of the woes are self-induced, common prosperity, and of course their COVID zero policies are resulting in very, very slow growth, and now they're struggling with a property market that is deflating. But the reality is a lot of those Southeast Asian economies will still grow, and there will be opportunities there. So, it's during times like now where we would be looking at some of those assets and taking a longer term view and saying, well, at some point, presumably once Z gets elected back as premier, you will see COVID zero start to reduce and growth prospects start to improve. And I suspect this time next year, China perhaps won't be in the position that it is today, and prospects might look slightly brighter, and that would be reflected in perhaps some of the asset prices of these economies which have been bashed up.
Thanks, Iain. I don't take your 12-month predictions too lightly, because I remember if we rewind a year ago, you were talking about the rate cycle we potentially face and these long-duration assets and the risk that they do pose. I was quite surprised when I looked at your portfolio last month, and I don't know how much has changed, where you added a little bit of Meta or Facebook, you added a little bit of, was it Alphabet or Google?
Yeah.
I think more meaningful in that Google position. Was that a fact of these things being sold off, and at a PE level, it looked like a nice entry point for you guys?
Yeah, I think we really haven't had positions there for quite some time, and you've now got, I guess, an example in those two names where multiples have really been beaten up and are, one standard deviation or two standard deviations below long-term sort of median. And I guess our position in Google is probably quite a lot bigger than what it is in a Meta. That's pretty small. But the reality is those valuations of some of those shares are starting to look a little bit more attractive. And I think it's fair to say that, we're likely to see us buying some of those names if we continue to see more protracted weakness. And I'm not talking about technology. I'm just talking about perhaps some of the quality companies or the really great businesses that have been trading on very expensive multiples and are now starting to come back into the realms of reasonable value.
And that obviously ties in with your philosophy that you mentioned at the beginning of the session, or at least a principle within your Truffle philosophy of this short-term inefficiency with a long-term return to some sort of efficiency. And I think I remember you presenting on a slide where it's kind of SA equity is trading at around 63% of its historic PE. And then that speaks a little bit to your positioning from the SA perspective and holding the likes of APSA, etc. So, Iain, thank you very much for your time this morning. Again, it always goes very quickly, and we'll catch up with you in a month's time.
Great. Thanks, David. And thanks to everyone who signed in for this morning's session.
Yeah, so to echo Iain's comments there, thank you very much for joining us. Again, as always, highlighting or at least scribbling down a little highlights package. So we'll have a reversion to your normal PE levels as the market puts a logical price on a stock, and Iain gave the example there of APSA. COVID was a wonderful recent example of a potential short-term irrationality where good companies were sold down with low-quality companies and therefore offered a nice entry point. Ramaphoria was another example that Iain gave, where the guys at Truffle started to sell some of those, or at least trim some of that SA Inc. Exposure to take advantage of a potential over-optimism on the back of Cyril's incumbency. What else have we got here? Currently, there's a lot of bad news priced into South African assets. There is value in both equity, and Iain particularly mentioned the fixed income space as well, which are starting to look quite compelling. And I think local companies have done quite well despite some of the structural issues we face at a national level. Loose monetary policy over the years is currently being maybe a little bit unwound, and we've seen that in some of those long duration growth assets. And interestingly, Iain and his team starting to dig a little bit into some of those stocks. European banks have been bashed up, to quote Iain. Tail risks do persist, but more bad news has been priced in, maybe than their contemporaries across the pond of the Atlantic Ocean. So I'm out of breath. As always, thank you very much for joining us, and we'll catch up with you next month. Take care.